losing interest income and capital gains income and dividend income. Also, you're not spending your time building a business, so you're missing out on entrepreneurial income. So there are those costs that you're missing out on. It's just foregone opportunity, like opportunity that you don't do because your time is like filled elsewhere, basically. That's great, Caesar. Yeah, if anyone else has any other ideas for implicit costs, let me know. Yeah, feel free to state them during the class, like anytime during the class. So accounting profit is revenue minus explicit costs. Economic profit is accounting profit minus implicit costs. Economic profit is total revenue minus economic costs, and economic costs are both explicit and implicit costs. So economic costs equals explicit plus implicit costs. So here, these are so this is if you included explicit and implicit costs here. Economic profit, the difference between economic profit and accounting profit. I'll ask the class, what's the difference between economic and accounting profit?
Accounting profit is the like the on the books profit, the very like descript money profit, where economic profit you have to include the implicit costs and potential profit that you might be missing out on.
That's great. Yes, these are excellent. Yeah, that's perfect. Yeah. You hit it on the head. That's great. Yeah, that's the important difference with implicit like economic profit counts for non-cash costs, and then accounting profit just accounts for cash costs. It's important to account for non-cash costs because there's so many of them, and you're missing out on a lot of things when you're missing out on a lot of opportunities by doing a certain thing at one time, and there's a lot of opportunities that you're not doing. So it's important to account for that as well. So always account for that, because like you'd be working 40 hours a week, right? And then you're kind of missing out on, let's say, you could potentially be a real estate or mortgage agent, or let's say doing that while you're doing that 40-hour a week job, you're missing out on the income that you can be generating as real estate or mortgage agent. So that's an important cost, because like let's say you're making like $50,000 a year on your 40-hour a week job. While you are doing that, you are missing out on 200 grand, let's say, made being a real estate agent, estate/mortgage agent. So let's say that's what's happening. That's actually a real scenario here. This is like a real situation, because like a lot of people make $50,000 a year on a 40-hour a week job, while you could be working like the same amount of time for 40 hours a week and making $200,000 being a real estate mortgage agent. So like you're missing out on like you're missing out on $200,000 of implicit, so on implicit costs. So this implicit cost of missing out on that income is a big deal. yeah, you could be, yeah, so that's definitely in factoring in implicit costs are very important because yeah, there's a lot of income that you could be making if you were doing another type of work. So that's an important thing here. So economic cost, short run and long run. Short run, fixed plant, period too brief to alter its capacity, yet long enough to change the degree to which the current capacity is used. Long run, variable plant, period long enough to adjust the quantities of all factors, including plant capacity. So, so long run, like this, does anyone have any applications of this? Like long run, it's easier to change things than short run. Are there any applications of that in real life? Like if like in the longer term, it's easier to change things than the shorter term. So I'll share one. If you think of any, just uh feel free to interject. But gas powered cars are short run, long run. Good example of that. So in the short run, we won't get rid of our gas powered cars when gas is like hitting uh like we're not going to get rid of our gas powered cars in the short run, even when gas prices are higher than $2 a liter. But in the long run, we're going to get rid of them because it's easier to get rid of things in the long run. Like we're going to shift to electric in the long run. So it's easier to it's easier to change things in the long run. That's just the point of it. So we're gonna all shift to electric in the long run, but in the short run, it's too hard to make the decision to shift because there's just um yeah, in short run it's mostly fixed, and then long run it's variable, so we can change things in the long run. But if you think of anything that's allows for like in the long run it changes while short run it doesn't change, just let me know in the chat or unmute your mic. So any ideas? So here, total product, marginal product equals change in total product divided by change in labor input. Average product equals total product divided by units of labor. And law of diminishing returns. As successive units of a variable factor, say labor, are added to a fixed factor beyond some point, the marginal product that can be attributed to each additional unit of the variable factor will decline. So like how that happens is like it's kind of like a declining slope. So what it looks like is that it's kind of like this, where it just levels off. Like it keeps increasing, but at a decreasing rate. So kind of like this. So it keeps increasing, but it's like it's less steep as it goes on. Um so uh your total product increases, but increases at a lower rate as time goes on. So yeah, like it kind of like it increases, let's say it goes up like so total product goes up 20% this year, then goes up 10% next year, then goes up 2% the year after, and then eventually it just stops. It stops growing. So like then goes up 0% the year after that. So that's kind of how this works, the law of diminishing returns. So eventually when it goes up 0% the year after that, it just levels off. So like it goes completely flat. So that's kind of like how it works. So this is usually how it goes. Like as time goes on, it just starts to level off. So you see this with bigger companies. Big companies, this happens a lot. Smaller companies, it's more steep because they're growing very fast. So this table here, so we have units of variable resource labor on this column, and then we have total product TP on this column. So marginal product on this column, you got to do change in total product divided by units, change in units of the variable resource labor. It's change in 2 divided by change in 1. So does somebody want to fill this in and let me know what the numbers are? So for the first one, you would do 10 minus 0 divided by 1 minus 0. And then that would just be 10 divided by 1 equals 10. So if somebody wants to do, so you'd have to, the next one, you'd have to do, take these numbers, and the next one after that, you take these numbers, then these numbers, these numbers. So if anyone wants to try that, that'd be great. So yeah, like let's try to calculate marginal product for each one. So I'll give you like a few minutes if you want to try it. You don't have to do all of them. If you can just do a few, that'd be great. And then if anyone wants to do average product too, you would just divide total product by units of the variable resource labor. So 10 divided by 1 for this case equals 10. So you just literally take each one and divide it by the other, basically. So I'll give another minute if anyone wants to try that. So based on that, the first one, 15, 20, 15. That's great, Caesar. Great job, Chen-Chi. Yeah, it's great work. Yeah, that's exactly how you do it. So yeah, it would be, you totally got it. That's great. So yeah, it would just be, yeah, like, for this one, 25 minus 10 divided by 2 minus 1 equals 15. And then so on. So that's great. Great job. So when it's increasing like this, so like when it's going from 10 to 15 to 20, when it's increasing marginal returns. But when it's decreasing, so when it's going from 15 to 10 to 5 to 0, it would be diminishing marginal returns. And then negative marginal returns when it becomes -5. So when it's 0, that's when it stops growing. So like 0 is when it stops growing here. So stops growing. So that's an important point. That's kind of where the total product maximizes. So that's like the maximum amount of product that they create. And then average, you just do the total product divided by the units of the variable resource. So law of diminishing returns. This is how you would graph it. So in this region, it would be like increasing, marginal returns, and then decreasing marginal returns because it's like it's a lower slope, and then negative marginal returns. So you kind of want to level. This will be when production is when total production is maxed. So when marginal product hits its highest level, that's when it changes to from increasing to diminishing. Yeah. So when marginal product hits its maximum, then the marginal returns start to diminish. So then fixed costs are costs that do not vary with output. Variable costs are costs that vary with output. Total costs are sum of total fixed costs and total variable costs. Total cost equals total fixed cost plus total variable costs. So total fixed costs, in this case, would be 100 for each one. Total variable costs would be all of these here. And then total cost equals total fixed cost plus total variable costs. It would be you add all these here to get that. And then you get this. And then average fixed cost is total fixed cost divided by quantity. So we would do, we do 100 divided by, so we'd have to start here. So like 190 divided by 1, and 270 divided by 2, and 340 divided by 3, and so on. So if anyone wants to try to calculate average fixed costs, average variable costs, average total costs, and marginal costs for the first few, feel free. Or if you just want to do one of the ones, that's fine. So stay in the chat or unmute if you want. So here, I can do 90 divided by 1, 170 divided by 2, 240 divided by 3, so on. And then this one, you would do 190 divided by 1, 270 divided by 2, 340 divided by 3, and then change in total cost divided by change in total quantity. 190 minus 100 divided by 1 minus 0. And then 270 minus 190 divided by 2 minus 0. 340 minus 270 divided by, so 2 minus 1, 3 minus 2. So that's how you do that. So if anyone wants to calculate those, and a few of those, you don't have to do all of them. If you want to do one column or two or whatever, how many you want to do, the first 3, that or whatever you can do, stay in the chat or unmute. Yep. I'll give you like a minute, like maybe 2 minutes. So for this, the first few here would be 150, 33, and it just keeps it decreasing. The fixed cost, that's usually, so the fixed cost always decreases over time. So that's true. And then the average variable cost, it goes down to a minimum of 74 and then it comes back up. Average total cost goes down to minimum of 91.43 and then goes back up. Yeah. And then marginal cost here. So this is if you graph them here. So the total fixed cost would be the same over time. Total variable cost and total cost would increase over time. And yeah, so that's if you graph those. The average fixed costs, or average fixed cost equals total fixed cost of quantity. Average variable cost equals average variable cost is total variable cost of a quantity. Average total cost is total cost of the quantity. Marginal cost is change in total cost by change in quantity. So in this case, so average total cost is minimized here, and that's the most efficient point of production. Where quantity equals 6. So you want to produce there because it's most efficient. So when marginal cost is less than current average total cost will fall. And then when marginal cost is greater than current average total cost will rise. So when price of fixed input increases, average fixed cost and average total cost shift up. Average variable costs and marginal costs are unchanged. Price of variable input increases, average variable cost and average total cost and marginal cost shift up. Average fixed cost is unchanged. So shifts of cost curves, technology, improved technology, lower costs, cost curve shift down. Curve shifts depend on whether technology affects fixed costs, variable costs, or both. So yeah, in the long run, firms can change input always. So everything's more efficient in the long run because they can choose what their inputs are. So here, so long run, so the average total cost curve is adding up all individual average total cost curves. So that's how you get this. And as plant size increases, the number of factors will, for a time, lead to lower average cost of production, labor specialization, managerial specialization, efficient capital, and factors. So there can be diseconomies of scale due to shirking, worker alienation, communication problems, and control and coordination problems. So these are just lead to inefficiencies. So yeah, these types of things, like, you want to prevent those to stop diseconomies of scale. And then, so minimum efficient scale is the lowest level of output where long run average costs are minimized. It can determine the structure of the industry. So rising gasoline prices lead to increases in firms' short-run variable costs, marginal costs, and average total costs. Successful startup firms experience declining average total costs over the years it takes to eventually reach the levels of MES, daily newspaper, average fixed cost debt spiral. So these innovations, the version stamping machine, and aircraft and concrete plants, they make economies of scale a lot more efficient. So like with the version stamping machine, they allow automakers to make parts in 5 minutes and compared to with 8 hours for older stamping presses. So it's way more efficient. Way more efficient, and more is produced. Higher supply due to this technology. So shift supply curve right when this was created. And so we're going to go through perfect competition and the 4 basic market models. Then, yeah. So we're going to go through perfect competition, monopoly, monopolistic competition, and oligopoly. The pure competition has a lot of firms. The product is not very different from each other. There's no control over price. It's easy to enter. There's no non-price competition. And examples would be agriculture, so like corn, basically, or wheat. The farmers, they produce the same product, and there would be a lot of farms. The product is the same across all farms. It's not hard to enter, like in some cases. There's not a lot of price competition. And then monopolistic competition. There's many firms. The product is different. There's some control over price, but narrow limits. It's relatively easy to enter, but you have to do a lot of advertising, brand names, trademarks for non-price competition. So examples are retail trade dressed as shoes. So anything clothing related, because anyone can join a clothing industry. The barriers to entry are not that high, but you need an ability to produce the clothes. But you have to advertise, have brands and trademarks. And then oligopoly, there's only a few firms. The product can be very different or very much the same across companies. But how it works is there's a lot of collusion in a lot of cases because these companies protect each other, so they want to keep the oligopoly going. They don't want to have a competitive industry, so they work together to keep it as an oligopoly. So there's a lot of obstacles because they work together to keep the oligopoly going and prevent any competition from coming in. They do a lot of lobbying, so they talk to government to ensure that there's no competition. And there's a lot of non-price competition in terms of product differentiation. So this can be done through auto, farm implements, steel. In Canada, this happens with telecommunications and banking, but it's becoming more competitive now. But in the past, it was Bell and Rogers for telecommunications. And then for banking, it's just like BMO, TD, RBC, CIBC, Bank of Nova Scotia, but it's becoming more competitive. And then monopoly, there's one firm. There's no close substitutes to the product. There's a lot of control over price. There's no allowance for entry by other firms. There's some public relations advertising. So examples are local utilities, so like electricity, also subways, like subways in Toronto, TTC, that's a monopoly. Usually monopolies are government controlled because they have so much power over price that if they were a private company, it would hurt consumers too much because it would be too expensive. So governments usually control monopolies to make it affordable. So perfectly competitive markets need very the markets are very big and these companies are very small. Then the product is identical. There's a lot of perfect substitutes, and then they don't have any influence of the market price, and then there's easy entry and exit. So perfectly elastic demand. Firm produces as much or little as they want at the market price. Firm cannot obtain a higher price by lowering its output. firm does not need to lower its price to sell more output. Individual firms demand graphs as a horizontal line. Average revenue is revenue per unit, so total revenue divided by quantity equals price. Total revenue equals price times quantity. Marginal revenue is change in total revenue divided by change in quantity. So if you graphed total revenue and marginal revenue, you would get this. So in order to maximize profits, you need to set marginal revenue equal to marginal cost. So you got to produce where this happens. So make sure to produce where that happens. So where on this chart here would marginal revenue equal? Wait, oh, so it's not on this chart, but so where on this chart is profit maximized?
Nine.
Yeah, exactly. That's great. Thanks, Caesar. Caesar. Yeah, so like 299. That's great. Yeah, so in this case, 9 marginal revenue, marginal cost aren't on this chart, but 9 would be where marginal revenue and marginal cost equal to each other because profit is maximized. So this is where you want to be producing because that's when it's most efficient. So like that's when the lowest total cost, like that's when you maximize profit. Margin revenue to margin cost. So this graph shows like this big graph what they had in that chart. So at this point where maximum economic profit is $299, that's where profit is maximized. And this is where the profit is breaking even, where profit is 0. Yeah. So profit 0, profit 0, and then maximize profit. And then yeah, maximize profit. So in perfect competition, each company produces at price equals marginal cost. And also, so that they're forced to produce there, and usually it equals marginal revenue as well. So they're forced to produce where marginal cost equals price, but it usually also equals marginal revenue. So based on this, where would so is it true in this case that marginal revenue equals marginal cost when this the highest profit? Like, it doesn't exactly equal it, but is it true that it equals marginal cost, like marginal cost equals marginal revenue when the profit is highest? So yeah, it basically does like when the profit is highest at 299, the marginal revenue, marginal costs are just 1 apart, so they're basically the same thing. So that's true here. And then here, the profit's maximized right here when marginal revenue equals marginal cost. And then this is the economic profit. So if you want to calculate economic profit, you would do the 131 minus 100 times 9 minus 0. So 31 times 9. Yeah, so that's how you would do it. You would calculate the area of this rectangle. So then suppose the market price is $81 rather than $131. Still produce because price is greater than minimum average variable cost. The cost is less than fixed cost. Loss is at a minimum where marginal revenue equals marginal cost. So yeah, always produce. So like regardless of anything, like regardless of price being high or low, always produce at marginal revenue equals marginal cost. So you would calculate what the marginal revenue, marginal cost is you make a chart like this for your business with like average fixed cost, average variable cost, average total cost, total product / output, and then you find marginal cost and marginal revenue. And then based on that, you would determine when marginal revenue equals marginal cost, and then that's where you produce. So you'd produce about six output, because this would maximize profit. So break even is when like average total cost equals price. So that's when your costs basically equal revenues. And you want to shut down your business when price is less than average variable cost. Because you are making less revenue than than what you are paying your employees, basically. Like you don't shut down your business, so you don't shut down your business when price is less than average total cost, because average fixed costs are always paid regardless of if the business is open or closed. That's the reason. You're always paying fixed costs. That's why you keep the business going when price is less than average total cost. But you stop running your business when price is less than average variable cost, because you're not covering your employee expenses, basically. So then if there's an increase in wages, the supply curve shifts upward to the left, decreasing in supply, because it's more expensive to hire to have workers working. So there's gonna be less supply of workers. And then technological progress will shift the supply curve downward to the right, increasing the supply of workers. So should this firm produce? Yes, if price is greater than or equal to minimum average total cost. This means that the firm is profitable or that its losses are less than its fixed cost. What quantity should the firm produce? Produce where marginal revenue equals marginal cost. There, profits maximized or losses minimized. Will production result in economic profits? Yes, if price is greater than average total cost. So in this case, yeah, so this they produce at 8 supplied because the total quantity supplied and total quantity demanded is the same. So for firms facing losses due to fixed costs, shutting down in the short run does not mean shutting down forever. Important question for firms with fixed costs: will producing output make the hole even deeper? Low prices can be temporary.